Hi, my name's Eric. I'll be reading you selections from Barron's magazine with an issue date of July 27th, 2026. This is produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. We'll start with Up and Down Wall Street. Rising rates are a danger for markets. Tips are a good bet. Things are getting real. That is, when it comes to interest rates, and that's sending a reality check through the bond and stock markets. Real risk-free bond yields haven't been this high in years. Real 5 to 10-year yields hadn't reached current levels since 2023 and 24. As for 30-year maturities, you'd have to go back to the 2008-2009 financial crisis to encounter real yields of nearly 3%. Real interest rates are what you earn after the bite taken by inflation. When you can earn a healthy real rate with little or no risk, a risky investment needs to offer a significantly higher return. It isn't for nothing that the S&P 500 suffered its first two-week losing streak as real yields, as represented by Treasury inflation-protected securities, or TIPS, hit multi-year highs. Regular and nominal Treasury yields also rose to multi-month and multi-year highs on the resurgence of Brent crude oil, which passed the $100 a barrel mark on Thursday for the first time since May. The rise in real interest rates presents both dangers and opportunities for investors. Investors are being well compensated for owning TIPS, said John Thorndike, co-head of asset allocation at GMO, who noted that the firm has been adding long-term TIPS to its multi-asset portfolios, including its GMO Dynamic Allocation exchange-traded fund. For those with a longer time horizon, TIPS offer a way to hedge the risk of persistently higher inflation rates. To illustrate, the benchmark 10-year Treasury note yielded 4.68% this past week, while the corresponding TIPS maturity provided a real yield of 2.42%. The difference between those two yields represents the break-even inflation rate of 2.26% that the market implicitly expects. If the annual increase in the consumer price index is greater during the next decade, TIPS inflation compensation will make them the better buy. The rise in real yields means the market is pricing in a higher cost of capital, Thorndike explained. That reflects the demand for funding the build-out of artificial intelligence projects, the robust accompanying need for energy projects, and the term premium to compensate investors for the risk of government borrowing to cover huge and persistent deficits. Real yields also reflect Federal Reserve policies, Alex Malitas of Bianco Research Advisors pointed out in a client note on Friday. He found that when the Fed was actively engaged in quantitative easing, the purchases of government securities to pump liquidity into the financial system, from 2009 through early 2022, the 10-year TIPS real yield averaged just 0.23%. By contrast, in the pre-QE period from the turn of the century to 2009, the real 10-year yield averaged 2.74%. We've argued the current period should look like the pre-money printing period, and it does, he wrote. It also means 10-year real yields can go much higher before they become too restrictive, probably above 3%. Of course, Fed Chairman Kevin Warsh has made shrinking the Fed's balance sheet a long-term goal, which would be the opposite of money printing. For riskier investments, higher real interest rates necessarily mean a lower present valuation of the stream of future earnings. That effect appears to be hitting stocks of late, especially those involved with AI. Until recently, the technology sector was said not to be in a valuation bubble, but instead an earnings bubble. As a result, based on analysts' earnings for the coming 12 months, the price-to-earnings ratio for the S&P 500 is under 20, a relatively undemanding valuation. But profits are being flattered in a manner that recalls the dot-com era, according to Jim Chanos, who now manages his own money at a firm bearing his name and is renowned for his short calls on overvalued stocks. Accounting protocols make the numbers look even better, he explained in an interview. Sellers of equipment for the AI boom, such as NVIDIA, book the revenue and profits from their sales immediately. Buyers of the equipment, like hyperscalers such as Alphabet, don't immediately expense those purchases in their profit and loss statements. The capital equipment is depreciated over its presumed useful life. And for equipment purchased and not yet plugged in, the expense isn't recognized until it's put into service. The markets are coming around to recognize this accounting effect. This year, chip stocks are up sharply, even after a recent correction, while hyperscalers have flatlined at best. The reaction to Alphabet's earnings report this past week starkly illustrated this. Investors focused on the Google's parent's negative free cash flow, owing to projected AI CapEx of as much as $205 billion this year. So far this year, Alphabet has had to raise nearly $85 billion in stock and bond sales, a turnabout for a company that had easily funded capital needs internally. With real rates moving higher, the cost of financing is going up for the AI boom. The odds of the Fed raising its short-term rate target at this coming week's policy meeting crept up to about 36% on Friday from 13% a week earlier, according to the CME FedWatch site. But a quarter-point increase by the Fed's mid-September confab had about an 80% chance, given that inflation remains above the Fed's 2% target, and there's been a renewed surge in oil prices, all of which adds up to a real problem for markets. And that was written by Randall W. Forsyth. On to the Streetwise column by Jack Huff. Earnings season is here. Will euphoric be good enough? I tend to use rapturous too much. Must be all that Sunday school as a kid. So let's just say that with second quarter financial results rolling in, the earnings growth rate is trending somewhere between fresh-baked manna and angels with trumpets. But will it be enough to smite the bears? At the end of last year, Wall Street analysts who ventured guesses on second quarter earnings predicted 14% growth on average. It's a fairly common forecasting practice to use plus-size numbers as placeholders for distant quarters, and then lower estimates to more beatable levels as reporting season approaches. But that's not what happened this time. By the end of June, analysts were predicting 22% earnings growth. This past Thursday, with numbers already in for about a fifth of S&P 500 companies, growth was pegged at 25%. Evercore ISI, extrapolating the amount by which companies have been beating earnings forecasts, says we could end up with close to 28% growth. That's 4 times the typical annual growth rate since World War II. Stock market gains have lately lagged behind. Far be it from me to complain about them. The S&P 500 has quadrupled investor money over the past decade. This year it made 10%, or a typical full year's return by mid-May. But now it's late July, and we're only up around 9%, despite these transcendent financial results. Who do I talk to about a courtesy rally? There are justified concerns. Renewed Iran strikes have pushed Brent crude oil back to $100 a barrel and U.S. gasoline to $4 a gallon. Bond yields are up, and China, deprived of America's best artificial intelligence chips, has figured out how to Gilligan's Island its way to good enough supercomputing at a discount. Whereas the television castaways put a bamboo stationary bicycle to creative use, China's approach leans more on open source software and massive arrays of optimized workaday chips. One investment bank compares the U.S.-China AI battle to the Betamax VHS videocassette war of the 1980s. Beta was technically better, but VHS, the winner, was good enough and cheap to license. This explains why Alphabet stock tanked 7% on Thursday, after the company reported sharply higher revenue and earnings, including those from cloud computing. It also raised capital expenditure guidance by $15 billion this year to $200 billion at the midpoint of its range, and said next year's spending will increase significantly, as Morgan Stanley reckons, to $375 billion, or close to the value of Coca-Cola or Caterpillar. That is turning free cash flow sharply negative. Alphabet has been raising cash by issuing bonds. Jonathan Golub, chief equity strategist at Seaport Research Partners, remains bullish on the broad U.S. market. There's this general assumption the stock market's gone up too fast, and therefore that's a problem, he says. But if you buy a stock for more money, it's not necessarily more expensive, as long as the earnings that stock generates are going up as well. AI companies appear to be investing into ravenous demand, not ahead of it, says Golub. The median S&P 500 company is growing earnings at a sustainable-looking 8.5%. In tech, Golub is more confident in semiconductors and hardware than in the hyperscale data center builders because of the cash flow concerns. Outside of tech, he calls financials really underestimated, but says defensive investors should prefer Treasury bills to many consumer staples stocks due to weak growth. Let's turn to how I recently lost billionaire status, which was made more painful by my never having realized I had achieved it to begin with. Are you a time billionaire? Asked analysts in a new report from Deutsche Bank. That's someone who has 1 billion seconds left to live, or around 31.5 years. I'm normally a big fan of new gimmicky ways to describe simple concepts. I no longer nap, for example. I practice circadian management. Time billionaire is just another term for young, so I was ready to go all in. But out of curiosity, I did the actuarial math. I Enroned the numbers a smidgen by giving myself mortality credit for the statistically healthy county I live in, without mentioning that I also inhabit a less desirable neighborhood within the body mass index scale. I learned I'm only worth $938 million. What makes matters worse is that I couldn't resist digging deeper into where my attention was likely drawn on the precise day I slipped below $1 billion without realizing. It turns out that an Australian academic in a green two-piece running suit, Rachel Raygun Gunn, had just kangaroo hopped and floor rolled her way to viral internet fame for her breakdancing routine at the Paris Olympics. There's a documentary about it coming soon to Netflix called Untold Raygun, Breaking Badly. This isn't a cautionary tale about breakdancing. The Deutsche Bank report on time billionaires had some striking findings. Younger investors were overwhelmingly confident of strong returns over the next year. Most said they wanted to add risk. By a 10-to-1 ratio, Americans under 34 said they would be happy to let AI execute trades for them. If inflation, technological disruption, and asset price dispersion are perceived as threats, risk-taking can become a hedge against being left behind, the authors write. The study presents theories on young investors coming of age at a time of social media financial influencers, crypto assets, and zero commissions. Investment decisions are discussed, compared, gamified, and sometimes celebrated in digital communities, the authors write. That can make risk-taking feel less isolated, amplify fear of missing out, and lower the emotional cost of failure. To the young, embrace risk, but do so by saving long-term in cheap stock index funds, not flipping crypto. Make AI a source for quick answers, not a trading partner, and skip the chat rooms. Take it from a former member of the 10-digit seconds remaining club. Time's a powerful asset, so long as you invest wisely before too much of it kangaroo hops by. With a look back at last week and what's coming ahead this week, here's the review and preview section in Barron's of July 27th. Landing with a thud. Just over a month since its initial public offering, SpaceX has delivered one of the weakest post-debut performances of any major U.S. listing since the end of the 2008-2009 financial crisis. A Barron's analysis found that the stock performed worse than 90% of U.S. IPOs with market capitalizations of $1 billion or more since July of 2009. Over its first 27 trading days, SpaceX was down 23% from its first-day closing price of $161. Across 955 public offerings, the typical IPO returned 0.8% over the equivalent period. Poor IPO performance doesn't determine a company's long-term trajectory. Meta Platforms rewarded investors after a rocky debut, and weakness in the stock as the lockup period expired. SpaceX faces a similar challenge. Shares held by founder Elon Musk are locked up until June of 2027. Altogether, about 60% of the company's $13 billion in shares outstanding will then be eligible for sale. Other investors face shorter lockup periods. Major lockup expirations have often weighed on demand for momentum stocks in the weeks around the event. One mitigating factor, SpaceX's inclusion in major stock indexes, will trigger substantial buying from index tracking investors, hoping to offset selling pressure. SpaceX has already joined the Russell 1000 and the NASDAQ 100 indexes. It could join the S&P 500 after trading publicly for at least a year and meeting the index's profitability requirements. That was written by Elijah Nicholson Mesmer. Last week, in markets, a Tuesday stock rally came to a halt by Thursday, when oil hit $100 a barrel after Iranian-backed Houthi militants fired on 2 Saudi tankers in the Red Sea. The 10-year Treasury yield rose to its highest level in more than a year on inflation fears. Tech shares were dumped, with the Magnificent Seven stocks losing $889.3 billion in market value that day. Stocks were mixed on Friday. On the week, the Dow Industrials fell 0.38%, their third straight week of declines. The S&P 500 lost 0.61%, and the NASDAQ closed 2.13% lower. In companies last week, Alphabet's earnings beat estimates, but its forecast for higher artificial intelligence spending sunk the stock. Alphabet's Google was fined $1 billion by the European Union for illegally undercutting competition with its dominant search engine. Chipmaker Intel reported earnings nearly double analyst estimates, thanks to strong AI demand. In deals last week, Penske Corp and Japanese investment firm Mitsui proposed to buy out Penske Automotive Group in a deal that could be worth $3.78 billion, offering $210 a share to take the auto dealership chain private. The U.S. approved a landmark agreement with Saudi Arabia to provide the country with a civilian nuclear program and potentially open the door to uranium enrichment in the kingdom's territory. Potato chip and salty snack maker Utz Brands is going private in a merger with Germany's Intersnack Group at an enterprise value of about $2.9 billion. And what's coming up this week? On Tuesday, July 28th, roughly 160 S&P 500 index companies release results this week, including 4 of the Magnificent Seven. Boeing, Coca-Cola, and Visa announce earnings on Tuesday. That'll be followed by Meta Platforms, Microsoft, Procter & Gamble, and Starbucks on Wednesday. Amazon.com, Apple, and MasterCard report quarterly results on Thursday, while AbbVie, Chevron, and ExxonMobil close out the week on Friday. On Wednesday, July 29th, the Federal Open Market Committee announces its monetary policy decision. There's roughly a 1 in 3 chance that the FOMC will raise the federal funds rate by 0.25 percentage point to 3.75% to 4%, according to the CME FedWatch tool. Softer than expected inflation readings for June have given the central bank some breathing room, but Wall Street sees it as temporary, with a consensus view for an interest rate hike by September. On Thursday, July 30th, the Bureau of Economic Analysis releases the Personal Consumption Expenditures Price Index for June. Economists forecast a 3.7% year-over-year increase. That's 0.4 percentage point less than in May. The core PCE is expected to rise 3.3%, compared with 3.4% in May. And by the numbers, $750 billion. That's OpenAI's latest projected spending on computing power through 2030, up from an earlier $600 billion. 29. the number of days this year that the 30-year Treasury bond has traded over 5%, the most since 2007. 1,000 plus, the number of Americans with at least $25 million in their IRAs in 2024, more than double the number in 2019. And 7.3%, the one-year decline in the median listing price for single-family homes in wildfire-scarred Malibu, California. On to the articles. Medical device stocks are on sale. Danaher, Intuitive Surgical, and others in the sector have been clobbered. They could well bounce back. We size up 6 of the biggest, by Bill Alpert. Medical device stocks were already one of the year's worst sectors when they got hit by news from surgical robot pioneer Intuitive Surgical and analytical device maker and supplier Danaher. Intuitive stock has lost 17% since it said on July 16th that U.S. procedure growth was slowing slightly. Danaher dropped as much as 14% this past Tuesday when it told investors of a sales shortfall in its bioprocessing supplies. All of this confirmed fears of slowing healthcare utilization that have sunk the iShares U.S. Medical Devices Exchange-Traded Fund more than 20% this year. Those fears are overblown, and medtech stocks are a bargain. Device makers with cash flow yields of 5 to 6% now trade at 20 to 30% discount to the S&P 500 index. I've got the ability to invest in these high-quality medtech companies at higher free cash flow yields than a treasury, says Blake Goodner, co-founder of the healthcare-focused hedge fund firm Bridger Management. The chief reason for medtech's tumble is the artificial intelligence boom, as growth investors piled their bets on NVIDIA and other beneficiaries of hyperscale spending. Device stocks will regain attention as AI enthusiasm normalizes. Another worry is that patients are postponing medical procedures since the Affordable Care Act's premium subsidies ended in December. Goodner thinks federal spending on healthcare is stabilizing, while Medicare Advantage payment rates have finally turned positive after a period of negative annual updates. With midterms in sight, Republicans have stopped threatening to repeal and replace the ACA, also known as Obamacare. In a large part of this medtech ecosystem, you've seen growth slow, but still be durable, says Goodner. And you've seen profit margins and free cash flow expand, which could usher in greater share repurchases, dividends, as well as M&A. With that outlook in mind, we size up 6 of the biggest medical device stocks. We'll start with Abbott Laboratories. Their recent price, $100.57 a share. Their market value, $175.2 billion. Their 2027 earnings price-to-earnings ratio, 16.6. The 2027 estimated revenue growth, 9%. Abbott Laboratories brightened the sector's gloom with fine June quarter results that showed wider margins and growth in even its slow segments like nutrition. New nutrition products offer protein to GLP-1 users. Device launches are coming for treating heart arrhythmias and monitoring diabetes. With the stock at 16 times next year's estimated earnings, Raymond James analyst Jason Bedford thinks Abbott shares can rise 15%. Danaher trades as DHR on the New York Stock Exchange. Its recent price, $179.14 a share. Its market value is $125.9 billion. Its estimated price-to-earnings ratio in 2027 will be 19.4, and its 2027 estimated revenue growth, 8%. Danaher's June quarter was marred by order delays for the resins used to separate biotech materials. That led the company to tweak the year's sales growth forecast to 4% from 6%. The stock's ensuing plunge was unwarranted. Danaher actually beat the quarter's earnings forecast and raised earnings guidance for the year to about $8.53 a share. Demand for its lab supplies remains intact, as shown by the good June results posted on Thursday by rival Thermo Fisher Scientific. Next is Intuitive Surgical. It's ISRG on the NASDAQ. The recent price, $340.69 a share. Its market value is $120.4 billion. Estimated price-to-earnings ratio in 2027 is 28.5. The 2027 estimated revenue growth is 13%. Intuitive Surgical, the robotic surgery pioneer, has beaten growth expectations for 2 decades. Last year, it guided for 14% growth in surgeries and ended with 18%. The absence of a guidance boost in July 16th's quarterly report sank the stock, even though June earnings grew 24%. The stock's drop is a buying opportunity. Just announced competition from Johnson & Johnson won't dent Intuitive's robot monopoly. Few on Wall Street see less than 20% upside for the stock. Medtronic is next. It trades as MDT on the New York Stock Exchange. Its recent price, $81.89 a share. Its market value is $104.8 billion. The estimated price-to-earnings ratio for 2027 is 13.1, and the estimated revenue growth for 2027 is 4%. Medtronic's products for clearing carotid arteries are growing smartly, but its main products for cardiologists and neurologists aren't growing much. Growth in overall sales is forecast to slow to 4% in the next fiscal year from 7% in the current year. The stock trades as a cheap multiple of 13 times next year's earnings, but investors may want to wait until growth comes back into view. Boston Scientific is next. They trade as BSX on the New York Stock Exchange, and their recent price was $42.97 a share. The market value, $63.9 billion. Their price-to-earnings ratio estimated for 2027 is 11.6, and their 27 estimated revenue growth is 8%. Boston Scientific has been the hardest hit among the big device firms. The stock is down 50% this year, after the company trimmed guidance for 2026 sales growth to 8% from 10%. That's a big sell-off for a small adjustment. The company's well managed and has new products coming. With its stock at just 12 times forward earnings, it has a big buyback program, and its expected annual cash flow of $4 billion amounts to a 6% yield. The final medical device stock is Edwards Lifesciences, which trades as EW on the New York Stock Exchange. Its recent price, $84.37. Its market value, $48.6 billion. Estimated price-to-earnings ratio of 25 for 2027, and their estimated revenue growth for 2027 is 10%. Edwards Lifesciences shares have held their value this year while other med tech stocks tumbled. That's because the company's beaten earnings estimates as sales of its minimally invasive heart valve continue to grow. On Thursday, it announced that June sales and earnings also topped forecasts. Bedford at Raymond James calls Edwards one of the cleaner growth stories in large-cap med tech. The next article in Barron's of July 27th, Musk is losing his magic. Tesla's paying the price. A $1.3 billion miss on quarterly earnings is raising broad questions. Some investors are tired of hype followed by a lack of follow-through, quote unquote. This is written by Al Root. Tesla's post-earnings tumble was about something more ominous than an earnings miss. Elon Musk may be losing his golden touch. There's no way to sugarcoat it. Tesla's second quarter earnings report was lousy. This past Wednesday evening, Tesla announced a second quarter operating profit of $398 million. That's down from $923 million a year ago and far below Wall Street's expectations for $1.7 billion, according to FactSet. The $1.3 billion miss was caused by weaker pricing and a weaker vehicle mix, lower regulatory credit sales, rising costs, and higher research spending. The miss, however, is the least of Tesla's problems. Whether to buy or sell the stock has never really been a decision based on fundamentals. It's always been a bet on the future and Musk's ability to see and articulate it more clearly than anyone else. But with shares down 14% after the release, the worry is that the market has started to doubt his foresight. Investors are losing patience in hype followed by a lack of follow-through, says Future Fund co-founder Gary Black. There was plenty of hype on the earnings conference call. The robo-taxi business continues to see very high compound growth rate, and robots will still be the biggest product ever, Musk said. The Mercurial CEO even introduced a potential new business, the Megapod, essentially a small modular artificial intelligence data center with Tesla hardware doing much of the computing. Wall Street doesn't seem overly worried about Tesla's future. No analysts upgraded or downgraded shares in the immediate aftermath of the quarter, while the average price target dropped just $8 to $392 according to FactSet. The analyst community seems united in the view that Tesla is spending more now to make more down the road, and that higher spending typically squeezes profitability. Phrases like working through a business transition, accelerating CapEx cycle necessary, and the potential for a transformational year are scattered throughout reports. Still, the stock dropped by about 7 times the price target decline on Thursday, a sign investor confidence is starting to wane. That would be an enormous change. Musk's great gift has always been the ability to get credit for potential, and it's a big reason Tesla stock trades for roughly 175 times 2026 earnings, while the rest of the Magnificent Seven trade for an average of 24 times. The valuation is already saying that investors are paying less attention to vehicle deliveries and more attention to whether high-margin software, autonomy, power, and eventually robot revenue arrive quickly enough to offset structurally lower auto margins, says Bill Birmingham, managing director at Rex Shares. The solution is easy. Musk needs to show results. He's done so in the past. Tesla has sold almost 10 million electric vehicles over its history, and 1.5 million people pay for the company's full self-driving or FSD driver assistance product. Now, Tesla needs more robo-taxis more than operating income, or humanoid robots that will become the next high-margin revenue stream. Something, anything, that will restore Musk's narrative-shaping power to full strength. We've walked this Tesla tightrope before, says Canaccord analyst George Gianarikas. He still rates Tesla stock a buy, though his price target did drop by $40 to $410 after earnings. History has taught us betting against Elon Musk is usually a fool's errand. Shareholders better hope that history repeats itself. Now we'll move on to the cover story. This boom is for the AI anxious. 10 ways to cash in. Artificial intelligence and data centers are in the spotlight, but investors should pay attention to a less noticed boom in global manufacturing. This is reported by Reshma Kapadia. Novartis started construction this year on a 700,000 square foot manufacturing hub in North Carolina as part of the Swiss drug maker's $23 billion investment in U.S. manufacturing and research and development. South Korea's Hanwha Group is expanding the former Philadelphia Naval Shipyard with a $5 billion investment to help rebuild U.S. shipbuilding. In India's Kutch Desert, wind turbines, solar arrays, and high-voltage transmission are being installed, creating the world's largest renewable energy park as the country looks to reduce its reliance on foreign oil. As data centers and artificial intelligence dominate the headlines, a less noticed building boom is underway, stretching across the globe as nations attempt to jumpstart their industries in a bid to bolster national and economic security. This new global industrial cycle is sparking demand for building materials and equipment on construction sites. commodities needed for renewable energy and power grids, engineering services, and the automation and industrial components to build new factories or retool existing ones. All of that spells opportunity for investors. We have 4 to 5 simultaneous capex booms, said Steve Cheveroni, Deputy Chief Investment Officer at Federated Hermes, who sees this infrastructure build-out as the biggest since the U.S. railroads in the late 19th century. In addition to data centers, that includes upgrading national power systems, shifting production to the U.S. to avoid tariffs, and modernizing factories. All of that calls for upgrading basic infrastructure, such as ports and bridges. The U.S.-China rivalry in the COVID pandemic during the first Trump administration spurred discussions about diversifying supply chains away from China. But last year's global tariffs, China's successful use of its rare earth dominance as leverage in trade talks, and another series of conflicts have kicked those efforts into high gear. That in turn has fueled a race by countries to diversify their energy sources and reconfigure supply chains, especially for critical materials such as rare earth magnets or the foundational chemicals needed for drugs. Security first. Security is increasingly the industrial policy across the board, says Benjamin Barr, a fund manager at First Eagle Investments. Since Trump's second term, geopolitics and demands have accelerated, with 2 major geopolitical conflicts that have impacted logistics and the massive increase in demand from AI and electrification. Spending has gone from a policy idea to necessity. The U.S. unveiled a $12 billion public and private partnership this year that includes investments in companies like MP Materials to ease China's stranglehold on rare earths, needed for everything from cars to weapons. Japanese Prime Minister Sanae Takaichi is proposing $2.3 trillion in investments across 17 sectors to revitalize Japan's economy with an eye toward security. The European Union has proposed an €800 billion, $914 billion package for rearmament and infrastructure. India, hit hard by the Iran war, is expected to invest $170 billion this year to bolster its energy resilience with grid improvements and investments in nuclear and solar energy. Investors are catching on. The State Street Industrial Select Sector SPDR Exchange Traded Fund, or ETF, is up about 20% over the past year. Industrials are trading at a mid to high single-digit premium to the S&P 500 index rather than in line, as they typically have done. That's partly because manufacturing is coming out of a funk as the U.S. emerges from a 25-year decline in U.S. manufacturing capital spending. Chris Snyder, Morgan Stanley's head of U.S. multi-industry research, expects an incremental $10 trillion in spending in U.S. manufacturing over the next 2 decades, and that's before factoring in the spending for data centers. The spending would translate to the U.S. industrial economy going from almost no growth to 3% plus annual growth, Snyder says. That sets up a favorable backdrop for stocks that could push valuations roughly 30% higher, adds Snyder. Jefferies industrials analyst Stephen Volkmann likens this industrial arms race to the 1960s with the build-out of the Eisenhower highway system and a manufacturing construction boom amid Cold War spending on defense and space, technological modernization, and suburbanization. Flush factories. The U.S. ISM Manufacturing Purchasing Managers Index hit 54 in May. That's its highest point since mid-2022, and the 5th straight month in expansion territory. Global manufacturing PMI is nearing its strongest readings in recent years at 52.2 in June, and Morgan Stanley's Asia-Pacific strategists see Asia entering its strongest industrial cycle since the early years of this century. Any pullback in AI investment would hit many companies, and probably the broader market. But fund managers expect the spending related to national security, self-reliance, and infrastructure upgrades to remain critical for the resilience that countries are seeking. Strategists think this industrial cycle will have long legs. As governments invest, they create incentives for others to join. Venture capital firm Andreessen Horowitz launched an American dynamism practice to focus on defense, manufacturing, and aerospace startups, bolstering the country's economic security. J.P. Morgan Chase launched a $1.5 trillion security and resiliency initiative that aims to make direct equity investments to help fill the holes in sectors critical for national security. That includes robotics, pharmaceutical precursors, and rare earths, plus frontier technologies like AI, quantum computing, and cybersecurity. Also in this bucket, defense technology, battery storage, and ways to make the power grid more resilient. Some beneficiaries, like European defense companies, have had a strong run, and they may be in for a breather. Others, like South Korea and Japanese industrials that have become dominant in automation, robotics, and shipbuilding, are well positioned for this industrial revival. They're worth keeping on a watch list if there's a pullback in the AI-oriented hype that's driving their broader markets higher. The fund industry has jumped in with new products, such as the $291 million TEMA U.S. Manufacturing and Reshoring ETF, geared toward mid-cap stocks and up 31% year-to-date. Two older and broader infrastructure ETFs are among the ones seeing the most inflows, according to Morningstar Direct. The $13.9 billion Global X U.S. Infrastructure Development and the $4.5 billion iShares U.S. Infrastructure. Building blocks. Sam Clark, who manages the actively managed GMO Domestic Resilience ETF, says investors aren't fully appreciating the potential winners. He cites companies facilitating the building like Jacobs Solutions, an engineering and construction firm managing complex projects such as a new biologics facility manufacturing GLP-1 drugs in North Carolina. Concerns that the company could see AI cannibalize parts of its business have hit the stock, which is trading at a 20% discount to the market. But Clark sees the AI fears as misplaced and expects double-digit earnings per share growth over the next 5 years. They are in a perfect place for the reindustrialization of America because they help build complex stuff with precision engineering that's not easily replaced by AI, Clark says, adding that the company has raised its EPS guidance and has been buying back stock amid the volatility. Among the most basic beneficiaries of a building boom are companies providing the aggregates for construction, such as Martin Marietta Materials, which recently agreed to a $13.5 billion acquisition of Lowest North America to create the biggest lime and limestone producer. The acquisition should bolster Martin Marietta's profitability and its exposure to a reindustrialization that isn't fully appreciated by the market, says Philip Eng, Jefferies Building Products analyst. For an industry where volumes have been flat, but the company has had a lot of pricing power, this reindustrialization opportunity could generate 3% plus growth on volumes alone, he says. Also, the company gets only 5% of its business from the data center build-out, and another 5% related to power infrastructure that also helps support AI, Eng says. Even if there is a pullback in that spending, analysts note that much of the money from the infrastructure bill signed during the Biden administration still has to be spent to upgrade highways, tunnels, and bridges, continuing to feed demand. Copper is a critical commodity for the electrification and digitization of the economy, needed for the power grid upgrades required to support a manufacturing revival. Grupo Mexico is home to Mexico's largest freight railroad and copper mining business through an 89% stake in Southern Copper, which has low-cost copper mines in Mexico and Peru, and projects lined up to expand copper production by 50% by 2035. Grupo Mexico stock trades at a 37% discount to Southern Copper and allows investors to get access to Mexico's rail network, another beneficiary of manufacturing moving away from China and into Mexico, essentially for free. Plus, the company is net cash positive, generating enough cash to fund its operations. If national security means rebuilding physical capacity, copper is one of the first bottlenecks you run into, Barr says. Grupo Mexico owns the input everyone needs before the factories, grids, and data centers can get built. Beyond data centers, equipment rental companies such as United Rentals and WillScot Holdings are leading indicators of manufacturing activity. WillScot's mobile offices, for example, are often the first and last thing on a construction site. Both companies reported a pickup in orders in recent earnings calls. WillScot said the 8% order growth for its modular units in the first quarter beat its internal expectations. United Rentals CEO Matthew Flannery highlighted strength in orders related to industrial, power, mining, and minerals as a wide variety of new projects, from healthcare to power, got off the ground, adding that the momentum is a lot broader than just data centers. Both stocks trade around 20 times 2027 earnings. Analysts expect 14% earnings growth next year for United Rentals and 23% growth for WillScot. The new manufacturing being built in the U.S. and developed world is likely to lean heavily on automation. That's one reason Rockwell Automation is a top pick for Morgan Stanley Snyder, who favors companies facilitating the supply chain migration and building American industrial capacity over manufacturing themselves. Rockwell is likely to see the benefits of industrialization faster, since companies look to retool or expand existing plants before breaking ground. The focus on national security probably means that some of Rockwell's Chinese rivals won't be competing for the same business in the U.S., Snyder adds. The stock trades at 32 times earnings, a premium to the market. But Snyder says the valuation is near where it traded during past periods of strong orders in 2018 and 2021, yet its earnings outlook is better. It's unclear why the stock should trade at a discount to its own history when the market growth outlook and company execution has improved, he adds. And as U.S. manufacturing capital spending returns from 2 decades of flatlining, Snyder sees longevity to Rockwell's growth, which he thinks underpins the case for a higher valuation. Asia's advantage. Among the best places to tap this industrial boom globally is in Asia, especially South Korea and Japan. They've been building their industrial capacity for years as the U.S. and others focused elsewhere. That makes their companies appealing partners for Western companies that might be trying to reduce their reliance on Chinese companies in critical areas. South Korean defense companies, Hanwha Aerospace and LIG Defense and Aerospace, are seeing an influx of orders and multi-year backlogs amid demand from the Middle East and Europe, says Ian Chun, a senior research analyst at Sands Capital. South Korea has emerged as the second largest arms dealer to Europe after the U.S. Many industrial Korean companies are standouts in their niches. Hyosung Heavy Industries makes ultra-high voltage transformers needed in electric transmission and within the broader electric value chain, something few companies produce, Chun says. The company has a foothold in the U.S. that's helped it emerge as a trusted supplier and gain market share. While orders may take longer to build, Doosan Enerbility is one of a handful of companies outside of Russia and China that can provide a critical component for the build-out of nuclear energy in Western countries. The broad-based iShares MSCI South Korea ETF has about a fifth of its assets in industrials, including Hyosung Heavy and Doosan, giving U.S. investors an easier way to get into these companies. South Korea's Kospi Composite Index is up 61% this year, fueled by excitement over memory giants SK Hynix and Samsung Electronics and momentum-driven retail investors. While analysts don't see the valuations for many of these industrials as too rich, the market is susceptible to volatility. Strategists see a pullback as a chance to buy. We are talking about multi-year trends that are showing developed countries that they have to promote their own industry. And that is a durable trend, says Matt Gertkin, Chief Geopolitical Strategist at BCA Research. On to the funds column. The Age of Free ETF Trades is Ending by Louis Brahm. Meb Faber is irate. Fidelity is morally bankrupt, says the CEO of Cambria Investment Management. Fidelity, no question, is one of the worst actors I've seen in 20 years. Faber is mad about the fees that Fidelity's brokerage charges exchange-traded fund managers to sell their products and investors to buy them. Since at least 2024, Fidelity, which has 57 million clients and $18 trillion under administration, has imposed placement fees on ETF providers like Cambria to be on its brokerage platform. These fees can account for as much as 15% of each ETF's annual fee. More recently, Fidelity has penalized ETF companies that won't pay these placement fees, charging the ETF's end investors 5% of each purchase's value, up to a maximum of $100. What started as a small stable of 28 ETFs on Fidelity's service fee list in November swelled to 118 ETFs in June. Most are smaller ETFs run by boutique firms like Roundhill Investments and Miller Value Partners that need Fidelity's platform to thrive. I think short term, it's bad for holders of those small niche ETFs, says Mike Watson, head of Axos Securities, a brokerage and custodian for financial advisors. Some of those funds become almost untradeable. Not all boutique-run ETFs are small. The $25 billion Roundhill Memory ETF became a surprise hit as microchip stocks soared in the past quarter. There's a long thread on Reddit titled, "Is DRAM still worth it with Fidelity's 5% fee?" in which posters rage about the new fees and discuss switching to another broker. But they may be out of luck. In April, Charles Schwab executives discussed on the company's earnings call how it would soon charge similar ETF platform fees. CEO Rick Wurster explained, "There are places where there are people operating on our platform, and they're earning incredible margins, and we're bringing the client to them, or we're doing the hard work, and we're not capturing our fair share." Fidelity told Barron's via email that it wants a more consistent approach across mutual funds and ETFs regarding the placement fees it charges. As the support, service, and infrastructure required to serve the growing ETF marketplace have expanded in recent years, that approach has evolved accordingly. Investors will probably bear these costs as others brokers follow suit. Boutique ETFs may raise their fees to cover the placement costs, much like mutual funds did when they had to pay similar shelf space fees to Fidelity and Schwab in the past. As our ETF platform grows in scale and sophistication, we've begun thoughtful, often bespoke, conversations with asset managers regarding platform fees, Schwab said via email. These discussions are expected to take place throughout this year, with implementation taking effect no later than first quarter 2027. Yet giants like Vanguard and BlackRock are too powerful to squeeze. Although Fidelity's goal is to capture 15% of an ETF's fee revenue, placement costs are privately negotiated with each ETF provider. Perth Tolley, founder of Life and Liberty Indexes and creator of the index tracked by the $3 billion Freedom 100 Emerging Markets ETF, says she knows of firms paying anywhere from 4% to 15% of fee revenue. There are different deals with everyone, she says. Tolley compares the pressure to make the payments to having a gun to your client's head. Our clients are everything to us. They're family. Vanguard does not make payments for preferential placement or treatment of its products, a spokesperson said via email. Vanguard may make payments to financial service providers for things like events, data, and other services. Payment for financial data is a common backdoor form of revenue sharing. Vanguard declined to disclose any details. We will close with the International Trader column. Mexico stocks thrive despite the Trump rift, by Craig Mello. The honeymoon between Mexican President Claudia Sheinbaum and U.S. counterpart Donald Trump is over. The marriage between two economies that racked up $873 billion in two-way trades last year abides. Investors are focusing on the latter. The iShares MSCI Mexico Exchange-Traded Fund has traded water since the U.S. administration's July 1st announcement that it wouldn't renew the U.S.-Mexico-Canada Agreement, or USMCA, on free trade. That leaves Mexican stocks up 10% year-to-date. The peso has risen more than 3% against the dollar in 2026. Those gains are holding despite Mexico being nearly twice as dependent on exports to the U.S. as Canada relative to gross domestic product, and the two leaders' discourse turning from warm to prickly. Mexico's foreign ministry recently asked U.S. state attorneys general to investigate the death of 14 Mexican nationals in ICE detention. Trump has called Sheinbaum a scared woman who has lost control of her country to narcotics traffickers. People assume Mexico's going back to the Stone Age, but markets are calm, remarks Malcolm Dorson, head of emerging market strategy at Global X ETFs. One reason is that not renewing USMCA doesn't mean tearing it up. The pact remains in force for another 10 years, even if the review scheduled for 2026 flops, which it may not. U.S. and Mexican negotiators locked horns again this week on a long Washington wish list, from more U.S. content in cars to stronger barriers to Chinese goods sneaking in through Mexico's back door. Last I heard, the U.S. had a list of 54 issues, says Michael McAdoo, a director for global trade and investment at consultant BCG. Sheinbaum is presiding over stable, if not dynamic, macro conditions. With inflation holding to 3 to 4% annually, the 9% plus yield on 10-year Treasury Mexican government bonds spells a super attractive real yield. Mexico's positioned to benefit from the U.S.-driven artificial intelligence explosion, too. They're the second largest exporter of GPUs, graphics processing units, to the U.S. after Taiwan. Hyperscalers in the U.S. have plans to sink more than $80 billion into data centers south of the border where land and labor are cheaper. His top Mexican stock pick is Corp Inmobiliaria Vesta, an industrial real estate developer poised to cash in. Coming up to 2 years in power, I give her a C+ or a B- about Sheinbaum. Her adroit fencing with Trump has also masked paralysis on domestic reforms that might boost economic growth past the annual 1%-ish that Mexico eked out over the past few years. She hasn't budged in particular from the state stranglehold she inherited on the hydrocarbon and power sectors. At a certain point, you have to move forward. A C+ or a B-, well, that grade looks good enough to keep clipping coupons on Mexican debt, though. And with that, we've come to the end of our reading of Barron's for July 27th of 2026. This is your reader, Eric, saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.